All right. Today is Thursday, the 10th of July, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. You know where I want to begin? I want to begin with a discussion that we had on Discord today, which I thought it was really interesting, because the sentiment in the market right now reflects headlines like this. Nvidia is now a $4 trillion company. And there is a lot of frustration by, let's say, investors who are looking at the macro and the bad news from trade and whatnot. And they think, okay, nothing matters, Mav. We have thrown everything on the market, the tariff, the bond market volatility, all of the problems that we have with the consumer, and nothing really matters anymore.
I don't know what to do. I don't know what to do.
You can act like a man! What's the matter with you?
And of course, thank you for the viewer who was patient enough to have the discussion with me in Discord, but the question was pretty much around this narrative of nothing really matters anymore. Even the macro data from this point on will be cooked, so why not just take the easy bet? Why not just join the party? Why are we not participating, the viewer says. And this is what I want to address. Why are we not participating? And there are two ways to answer that. The first one is, of course, specifically to what the viewer was addressing, which is, hey, Mav, all of the data that we get will never reflect the reality of the economy. And it's going to be received warmly by the market anyways, because they're going to cook the data. So why not take the easy way and participate by buying calls or buying stocks before these data releases and assume they're going to be positive? And my answer to that is, sure, if you spot a theme that's going on, that's what you got to do. Maybe you're going to be the unluckiest son of a bitch in the world and you bet on, let's say, next week's CPI to come out cool and the market goes higher. But next thing you know, it becomes the report that crashes the market because we're seeing the tariff impact on inflation. You never know. But for now, the theme is, yeah, most of the data release has been received positively by the market. But about the other point of so-called not participating, and I see a lot of fixation by the investors and traders on the index and on the big caps. And this is so misguided. I'm going to show you the evidence right now. And what you need to understand is you have to participate where you need to participate. You have to participate in themes that have a lot of growth intact, but one step at a time. This is a really interesting study by LPL Financial. And what it shows you is, you see the percentage points, the negative percentage points right here. That is the median stock distance from the 52-week highs in each sector. For example, in comm services, the average stock, the median, is down 8% from the 52-week highs. In consumer staples, 16.6. In healthcare, 19.7. Even in technology, down 12% from the 52-week highs. In the S&P, all in all, the median still down 12.1% from the 52-week highs. Now, the orange little bar that they got right there, that's the sector distance from the 52-week highs. So you see the S&P is already above the 52-week highs. You see technology, industrials, all of these are already at or above the 52-week highs. But yet the median stock in these sectors are still down. What does that mean? The market rebound, for the most part, happened on the backs of a handful of names. And this is a huge warning sign, by the way, that this is not a healthy rebound as everybody's touting right now. So keep that in mind, but I want to bring your attention to something important. This is what I gave the viewer in Discord. I said, look, all of this talk about not participating and, oh my God, the market is bullish and all-time highs and everything is flying higher. Year to date, the S&P 500 is up 4.8%. On the other hand, platinum up 50%, copper up 34%, palladium 29%, soybean oil 29%, silver 23.5%, gold 22.25%. You can see all of the other currencies, other markets that are outperforming the S&P. So I don't get what the hype is about the technology stocks, the big caps, and the S&P. You look at the half-year performance by sector, the resources trade, the materials, beating technology. How come folks don't talk about this trade, the resources trade, which we've been talking about since the beginning of the year, and all of the fixation is on these big cap names and the AI mania and the index level? To begin with, here's the year-to-date performances. The Spider about, let's say, 5%, 4 3/4. NVIDIA is up about 22%, Microsoft up about 19%. All of these are impressive gains, but I'll show you in a minute that they're not really that impressive when you consider certain factors. You look at Google down about 6%, Apple down 15.5%, Amazon up about 1.25%-ish. You got Meta up about 24.25%, so the majority of the gains in this spot are coming from NVIDIA, Microsoft, and Meta. Now, You factor in the fact that the dollar is down about 10% year to date, you gotta shave off 10% from all of these gains. Unless you're consistently buying the dips and adding more risk, if you just held the stock market year to date, you're down 10% on every return that you got. So the spider is actually negative year to date if you factor in the dollar. As to not participating, Mav, you're not participating, you're still bearish. Yeah, I'm still bearish. But being bearish doesn't mean that you're not investing in themes that solidify your bearish thesis against the economy and against the market. I'll give you some of the stocks that we have in the portfolio that are outperforming this garbage on the left. The steel ETF, for example, SLX is up 22%, Freeport-McMoran Copper up about 24.5%, Valero Refiner up about 26%, Estee Lauder, China Play, up about a little over 22%, Dollar Tree is up over 44.5%, Corteva, a bit on agriculture and grain demand, up 36%, Raytheon up 26.5%, Wynn Resorts up 30%, Melco up 52%, Alibaba still outperforming NVIDIA, up 26.77%, Wheaton Precious Metals up 60%, Mosaic up 46.25%. So yeah, Mav is not participating at all in this market. Come on, give me a break. You're fixated on this garbage on the left because that's the only thing that you know. But the market is a huge, big feast, and you have to pick where you can actually have sustainable growth in themes that are not transitory. Not to mention themes that are not overinflated right now. And we'll show you why in a minute. But another trade, which is you look at the international markets, for example, while you have the spider, oh my God, it's up so much. It's a new bull market, up 5% barely. Okay, Spain is up 44.5%, Italy up 48.5%, Korea up 44%, Greece up 58%, Mexico up 29%, Austria up 42%, South Africa up 29%. Again, if you followed the resources theme, the China theme, the weakening of the consumer theme in Dollar Tree, for example, in my portfolio, you've outperformed the entirety of the market with zero tech exposure. If you followed the international theme, you've outperformed the stock market without the need of NVIDIA, Microsoft, or Meta, or any of these names. Even if you just went with the popular retail investors' names, Palantir up about 88.5% year to date, Carvana up about 70%, Roblox up over 81.5%. So I don't understand the fixation about the index and the fixation about the big cap technology stocks. That's a dying theme. It's just a matter of time now. And that's my philosophy in investing. I don't want to chase a bubble because we go back. I've seen it before. That's the problem. A lot of you did not see it before, but I've seen it before. This is the NDX NASDAQ 100, the dot-com bubble. If you bought every dip during the dot-com bubble, all of them worked out. Every dip was leading to higher gains. And if you've been bearish in the NDX, you've been wrong for years. But then what happened? Came the dip that kept on dipping. And of course, everybody's programmed to buy the dip because it worked out the last 4, 5, 6, 7 times. So why not do it right now? Except this one is the one that breaks you back. And fast forward, all of these folks who bought the dip went down underwater. All of these gains, poof, gone, goodbye. And guess what Warren Buffett was doing while everybody was fixated on the dot-com trade? Warren Buffett said, yeah, I don't like it. Doesn't make sense to me. And folks said Warren Buffett is old and he's losing and he's not participating in the 21st century and all that garbage. But in fact, Warren Buffett was actually focusing and concentrating on the next bubble and the next theme. He was buying roofing, piping, a lot of materials, building and banks and homes, housing stocks. And then the dot-com crashed and Warren Buffett proven right again. That if you stick with themes, you see them ahead of time, and you stick with valuations that make sense relative to the growth, you're always going to outperform the market. And you don't have to participate in the hottest themes. The only technology stock that I got in my portfolio is a cybersecurity stock. And Trade Desk, of course, because that went down big, so we had to grab it. But it's a value proposal. It's not really investing in technology because I believe that tech is going to continue to go higher. So you can beat the market with zero tech involvement. You just have to spot these themes. And I told you before the year began, the days of passive management, of just buy the ETF, buy the big cap names, those days are over. You're going to begin to underperform right now. This period is all about active management. You have to pick themes, pick individual stocks, and go with them. So again, I hope that addressed all of the talk about, hey, Mav, you're not participating. The index is all-time highs. NVIDIA's up, whatever. Who gives a shit? I'm beating all of them. Anyhow, let's segue to the morning brief really quickly here. We talked today about the zero DTEs, the importance of NVIDIA 165 and 170 calls with the expiration date of tomorrow. We're going to revisit this. You don't want to skip the options market coverage because I'm going to try to speculate on where the market maker is going to close tomorrow. But we talked about the rare earth metals. See, that's another theme. So while you're fixated in NVIDIA, you got these resources stocks that are exploding significantly higher. So we talked about MP, which exploded higher today based on a contract with the Pentagon and USAR. And I said I'm taking my profits from MP, done with it for now. I'm going to book half of USAR and keep half. MP, of course, we've been talking about it for a while, but on the 8th, I suggested that perhaps there is a bullish breakout happening. So we should be buying the dip in MP. I also gave you the cut loss because the next day wasn't performing pretty good. So I said if we close below 29.62, I'm out. But thankfully, of course, we did not close below that number. So I didn't have to sell it. And what do you know today? This is the chart that I gave you when I touted the idea. Here's the update. Huge explosion higher. Again, this is not a technology stock. This is a miner stock. When you see the miners outperforming, that's another warning sign for the indices, for those who understand what I'm talking about. Ask AI, ask Grok. When materials outperform the stock market, what happens next? And then we talk about Conagra. Conagra was down big today, but Conagra is oversold. I know that the report is not good, by the way. The report is absolutely horrific. It illustrates that the same problem, by the way, that we've seen in Smucker and Mills. It's the same thing. You got these companies facing higher input costs from inflation and tariffs, but they can't pass it down to the consumer quite yet because the consumer is also being squeezed budget-wise. But once we see relief on the inflation front via recession, then their margins are going to improve. And I'm betting right now that we're probably reaching closer to a bottom in these staples names that have been underperforming, such as Mills and Conagra and Smucker. So today, I did buy the dip in Conagra. We also seen today a reaffirmation of the importance of the performance of the stock market to the spending in the economy, specifically by the affluent consumer. And this evidence came from Delta Airlines. Today, Delta came out and said, hey, the stock market is back up, and guess what? The bookings are now resuming. The consumer is now booking travels and buying tickets again. So we see a little bit of excitement about the consumer names, the banks, the retail stores, the travel names all did pretty good today. But I'm not impressed. They're probably going to sell call credit spreads, that is, for Delta or UAL. And I'm not the only one, by the way, thinking that I should fade the rip in airliners. You'll see a trader in the unusual activities also betting the same way. I'm also keeping an eye on RCL, another reflection of the boomer wealth and the affluent consumer spending. Of course, Crude has been hot. But we're eyeing a credit spread, call credit spread on RCL too, because all of these names are extremely overbought right now. But as we've seen before, you could call it overbought and you begin to do call credit spreads and the stock keeps going higher. So you got to use that little indicator that I gave you before you perfect the entry. Now, here's another theme for you. How about coal? Big, beautiful, clean coal. Why? Because believe it or not, coal is not clean, by the way, but I know that Trump loves it. And I know that the powering of AI data centers requires a lot of energy. And if you're going to use crude oil and nat gas, that's going to cost you a lot of money. So it's not good from an efficiency perspective. Now, the other alternative, of course, you see a lot of the AI companies investing in is nuclear energy. But that takes a lot of time to develop. That takes a lot of regulations. And the production, to be honest with you, is not pretty good here in the U.S. It's really, really limited. And this is why companies like Meta, for example, and the big guys are trying to secure and have a little bit of monopoly over that nuclear energy supply. An easy alternative to all of this, and it can power all of these data centers efficiently, really cheap, is again, big, beautiful, clean coal. And this is why this is another theme that you probably want to consider. We've been talking about HCC Warrior. We talked about BTU, all tickers for coal plays. And I touted the idea of HCC Warrior on the 8th, which was a couple of days ago. Chart looks good, giving us a bull flag pattern. And here's your update. We got a pop today, so we're beginning to see a breakout. And I think we see more gains to come in coal. It's a theme that is underappreciated right now. But the more you think about it, the better it looks. And with that, let's add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices. And here we go. The diamonds in the green, 192.34 points or a gain of 0.43%. NASDAQ underperforming today, up 19.33 points or a gain of 0.09%. The S&P is also underperforming, up by 17.20 points or a gain of 0.27%. That's because when we look at the heat map in a minute, you're going to see that the big caps took the back seat today, and the majority of the gains of the market happened via value stocks. You look at your leading indicator, Russell 2000, still okay, closing positive 115 points or a gain of 0.51%, but I don't like the close at the end. Quite a bit of loss of confidence by the end of the day here in the Russell 2000. We will see if that's a legitimate leading indicator or not. The weakness that we've seen in the second half of the Russell 2000 perhaps saying something about the market performance in tomorrow's session, one step at a time. We look at the sectors. Once again, metals, materials at number one. Number two, you got cyclicals because of the Delta airline news. You got real estate up, but that's with the backs of a couple of names, really. Healthcare is doing okay, with the exception of the insurance. And the laggards, comm services and technology. So today was sort of a value theme, not so much defensive, by the way, because cyclicals are outperforming the airliners, the hotels, so you can't say defensive, but it is more of a value theme today. Looking at the breadth, it is still a touch positive, which again, if the market maker is looking for maximum pain tomorrow, they have to close or at least open the day with a negative session because the breadth been initially negative Monday, then it improved a lot Tuesday, then it began to normalize Wednesday, and today, Thursday. Now, if you're the market maker, you need one negative session to balance it all out at around 50-50 and you exercise max pain. So my suggestion is we're probably going to see a negative session tomorrow. And maybe the options data supports all of that, one step at a time. Looking at the heat map, you see the sell-off today was in software and technology and cybersecurity, in the popular names like Netflix that ran way too high. Yet we see inflows coming in healthcare, we see inflows coming in industrials, we see inflows in utilities, in the metals, in energy, in defensives, some of the cyclicals too. So what is the message here? You have to pay attention when we talk about the heat map. A lot of you think it's useless and want to skip it, but we've seen a day where the managers with the volume showed up at the resources trade earlier this month. And now you see the huge gains. We've seen a theme earlier this month when we began the second half of the year, when the managers began to rotate out of the big cap technology stocks. These things happen a day and then the market normalizes again and folks forget about them. But there's a difference between the zero DTE's garbage volume, for example, which has been happening in the big caps, and then there is legitimate buying volume, what the money managers are buying. That's legitimate. That has more sustainability than the pumps and dumps you're going to see in the big caps. And these names that are being pumped via options market activities. And today we see a little bit of that theme that could show up today, then disappear. But what is the theme? Rotation back to value. The managers are beginning to diversify their exposure. And you see it happening in one day, but then the market goes, forget about the theme. But I pay attention. I see what the managers are doing because their buying volume is more important than the market maker buying volume just because folks are stampeding or manipulating the market via zero DTEs or weekly out of the money call options. You see it here in the heat map where you look at the VTV value. That is outperforming large cap growth today. And we also see some action mid caps. Small caps is beginning to cool off. So maybe we're beginning to see the managers rotating a little bit more to VTV value and mid caps. No major movement in the bond market at all. So we're not seeing a lot of movement in international markets or even in, let's say, sectors that are relative to the bond market, such as real estate, for example. IYR is up at 0.5 percentage point, but nothing more. So we don't see major moves here, except, of course, the XRT retail. That's based on the information that we got from Delta today. You see the XLY also outperforming for the same reason, even though the big name Amazon was a laggard today. Now, do we have faith that the consumer is back and they're going to begin to spend? If you believe Delta, sure, but I think that Delta is reflecting a certain level of the consumer. The rest of the consumers are not doing pretty good, so I don't think that's going to be pretty good for retail businesses. But again, today it's a day where we've seen the algorithms acting based on the news from Delta Airlines. We move on to commodities. We see pullback in crude oil today, down about 2.25% for the WTI, down about 2% for Brent, and down about a little over 1.25% for RBOB, and down a touch, a little over 0.5 percentage point in diesel. But we see nat gas finally rebounding about 5%. We got some news today about the inventories, that we have higher inventories this week, so we see a pullback But I think that crude oil is going to continue to outperform if the dollar continues to perform and continues to rebound. Nat gas, we've seen these kind of rebounds. I got to see more. I'm still not giving the vote of confidence for nat gas right now until I see a little bit more. In softs, we see cocoa down about 3.5%. Again, good for Hershey's, good for Mondelez. Lumber down about 1%, good for the home builders. And then you got sugar down about 2%. But we see rebounds in coffee about 1%, OJ rebounding by 6%, high volatility in OJ in the last few days. Now, with the dollar not moving much, but even with the rebound that we've seen in the dollar, I think that the performance of metals is absolutely impressive. The defensive gold is positive, but not by much. Yet we see silver up about 2.75%, platinum up about 2%, copper up about 2.5%. Your boy palladium up over 5%. The rumor is we're probably going to tariff palladium too, at least the ones coming from Russia. And then you have grains. Wheat is my favorite play, and we see wheat moving higher. Of course, wheat needs a little bit more support from the dollar and crude oil. But so far, so good. We're going to stick to these themes right here. Moving on to the options market, the big casino, what do we see here? I would still reiterate that we see more puts than calls in both Tesla and NVIDIA, and that's going to add pressure to pull back these names sooner than later. Even AMD showed up today a little bit, so we see the PC volume moving higher, the IV rank moving higher, and that's probably a suggestion that today's 4% pop maybe was an opportunity to book some profits, at least from a hedging standpoint. Now, I want to talk about tomorrow's expiration because a lot of you say, Mav, when you look at the following day's expiration or this week's expiration or next week's expiration, what do you see? Where do you see the market maker moving us? The short answer to that is it doesn't really matter. What matters is the zero DTs, what's happening right now, because we see the whatever traders who are getting engaged in the options market right now, manipulating the indices higher, their focus is day by day. The volume shows up for today's expiration, this week's expiration, but today's activities. And they're not really aiming even for a week out or a few days out. Their focus is just lather, rinse, repeat every day. Just keep buying calls out of the money every day and keep pushing the indices and certain important stocks higher. But if we must speculate here, we're looking at the 11th expiration date, calls versus puts. Of course, today the volume, look at the volume of the 625 puts. That is higher than any of the calls that we see. The highest volume of calls is 626. Now, you want to look at the bar. And if the bar going to the left, then that's buying volume. Now, if the bar is going to the right, then that's selling volume. So what do we see right off the gate? In the puts, we see selling volume for the 620 puts. In the calls, we see selling volume of the 630 calls. In other words, the feedback that the market maker is receiving today for tomorrow's expiration, the bears are saying, we don't think we're going to make it to 620. Market maker, we're bailing out. Now you can have that 620 as your floor. The bulls say, we don't think 630 is going to be a possibility tomorrow, so we're bailing out. So market maker, you can leave 630 as a ceiling. Now we have a trading range, 620, 630. Let's try to narrow that down a little bit more. The other thing we have to look at is the open interest. And the goal here by the market maker is to make sure that the highest open interest near the money will expire worthless. So if we look at the open interest for near the money, in the put side, the 625 has about 4,600 contracts. The 622 has about 2,000 contracts. But then you look at the big kahuna here for the calls, the 625 calls, it has about 16,650 contracts open. So if I have to speculate, I would look also at the volume out of the money. And you see opening volume for the 624, 623 puts. My 2 cents would say that the market maker is probably going to close below 625 tomorrow, and they might go as far as 623. If we see buying volume because of news about trade or any volatility event, if we see more buying of puts, zero DTEs, or for next week's expiration or Monday's expiration, we could make it all the way back to 620. But right now, the garden variety scenario would be closing below 625 in perhaps going all the way to 623. Another important name, because it is the market really, it's NVIDIA. So what do we see in NVIDIA today? What you're looking at is, of course, the volume. The call's been dwarfing the puts day after day after day. This is why NVIDIA keeps going higher. But we see closing volume at the 160 calls, as to suggest to the market maker that, look, we're out. We're going to book our profits. And now, Mr. Market Maker, Mrs. Market Maker, it, she, he, whoever, you may now exercise maximum pain and screw the 162.5 and the 165 call options holders. And these are huge numbers in the open interest. So my 2 cents would be the market maker would say, thank you so much, the 160 calls for closing today. Now I may push the tape down. How far down? Let's look at the puts. They're buying the 160. So probably 160 has a huge number of open interest to about 46,000. But the 160 calls has over 100,000 open. Some of these will be closed by tomorrow, but it's still a big number. So my 2 cents would be, sweet spot would be 160 or a touch below for NVIDIA. We'll see what happens. I'm just speculating here, using the facts and the data. Anyways, let's visit the unusual activities, beginning with the bullish ones. We begin with the ticker IBIT. Bitcoin. So Bitcoin is breaking out at least today, and it is part of the anti-dollar theme. Somebody sees more gains to come. I think the proper way to do it is this way right here, because it's not going to cost you a lot. In this case, they bought the 68 calls for IBIT. They sold the 73 calls to finance it, and the expiration date is August 15th. In other words, they think that IBIT will be above 68 by August, but not above 73. All in all, spending about $850,000. Got another one for you here for the SMH. This is a big one. Chips. Somebody buying the 290 calls. Right now we're trading really close to 290. And they're buying it for 2 different expiration dates. For December 19th of this year and then December 18th of next year. So they probably want to invest in the SMH and they want to do it safely via call options. Probably Nancy. And they're spending about $14.75 million, about $15 million. Then we have ZN, which is the 10-year note futures. If they're betting bullish on this one, what are they betting on, really? They're betting on that the 10-year yield is going to go down. And in this case, they bought the 113 calls, the expiration date November 21st, 2025, spending about a little over $2.25 million. It's a bet pretty much that the Fed is going to cut rates, or we're going to see a proper response in the long end of the yield curve. Premature assumptions, in my opinion, but got another one for you here for BE, Bloom Energy. Sounds like an insider trade to me. Now, mind you, yesterday we had an insider trade for the ticker RARE, and they got it right that there is a piece of news coming, which is the results of a trial. But the trial was disappointing. So they got the event right, the leak was right, but the result they were betting on was wrong. So somebody's going to get assassinated here. The point being is they're really good in spotting the insider information, but it doesn't mean that they're going to be right all the time. They hear the news, an announcement coming out tomorrow, but I can't say anything much. Somebody thinks it is a positive piece of news. They bet on it. They're proven wrong, and the stock goes down. But the point being is they got the event correctly. So here, in Bloom Energy, somebody bought the 28 calls and the 33 calls for the expiration date, August 15, 2025. Spending about a little over $1.25 million. If I had to speculate, probably somebody's going to buy Bloom Energy. Now let's segue to the bearish trades. How about DAL, Delta Airlines? Despite the good news, somebody's actually shorting the rip here. Stock is trading about 57. They bought the 56 and the 52 puts for the expiration date of July 25, 2025. Spending about a little over $1.5 million. Now they're also shorting UAL, which is trading in empathy with the news from Delta and now trading at about 92. In this case, they did not go with the puts, so it's not as bold as the Delta Airlines trade. They're rather using the bear call spread structure, or what we call a call credit spread. In this case, they sold the 95 calls for August 15th. They don't think that UAL is going to trade above that number by the expiration date. But the insurance policies, the 115 calls for the same expiration date, August 15. All in all, receiving a credit of about $1.6 million. Bottom line is, they're suggesting that we fade the rip in the airliners. And the last one I got for you is for the Qs. Somebody's betting for a correction to come by September 19th. Seasonality, perhaps. They bought the 535 puts and the 510 puts. Expiration date, September 19th. Spending about $5 million. Moving on to the charts. What do we see here in the E-mini futures daily chart for the S&P 500? Again, we're waiting for that rollover to happen in the MACD. Got to roll over, create some bearish momentum. And of course, the RSI is leading us to believe that that's going to be the case. And we have a little bit of weakness showing up here after hours because of the announcement of the Canada tariffs. But it's not done yet. It's not definitive that we're going to go down. I think we need to see a little bit more. We need to see a bigger break before you begin to see sellers showing up and all of this algorithmic confidence being erased. So, interesting session ahead tomorrow, to say the least. Some of the leading indicators for the market, like the HYG, doesn't look pretty good here because we got a bear flag that already kind of played out. We expand this to see it better. And maybe we're forming another one right here. we're going to head down again. If we do, then it's a confirmation that, okay, now we're ready for a correction. The HYG is giving us a confirmation. Another important indicator is small caps. Above the 200 days moving average for now, a lot of folks will split hairs about, hey, maybe we should look at the Russell 2000 futures 200 days moving average. Doesn't matter. They're both above. But we need to see a loss of the 200 days moving average before we have a confirmation that, okay, the market is indeed reversing and we have a bearish phase in the market coming. 30-year bond yield. What do we see today? The auctions were okay because they reduced the supply. Thank you to Besant, of course, using the same playbook from Yellen's. But it looks to me that maybe we're kind of retreating here in an ABC breakout. And I think the catalyst for a breakout could be the CPI coming out next week. If it begins to reflect some tariff inflation, say goodbye to the market and say hello to the 30-year bond yield, making it above 5% and perhaps breaking the highs. Dixie, rebounding, still holding, and I think we could see more rebounding to come, so you got to give it the benefit of the doubt right now because it's maybe moving higher here and producing a reversal from bearish momentum to bullish momentum. Of course, what would that mean for the market? Well, let's plug in the SPX and see what the decline in the market looked like for the SPX. Yep, you see decline in the dollar, market going higher. And you see the MACD of the market, the E-mini future, is about to roll over from bullish to bearish. On the other hand, you see the dollar about to roll from bearish to bullish. So my 2 cents is we're going to close the jaws here, where we see the dollar rebounding a little bit more, see the market pulling back, and then one step at a time. I don't expect the dollar to rally significantly higher. That's going to be bad news, by the way. It's going to be bad for the market. But I think we could see an oversold kind of rebound, which could produce an overbought kind of correction in the E-mini futures and the S&P 500. What does that mean for the old man gold? We're below the 50 days moving average. I'm marking 3,250. That's my hedging. So once we let's say test the support of 3,250, begin to break below, this is going to be my hedging point where I need to buy puts in gold or GDX gold miners or the SLV silver or calls in the UUP, whatever hedging mechanism you decide to choose. Right now, I think since we're trading above 3,250, I would say it's the proper time to sell covered calls in your gold holdings, but it's not so much the time to begin to buy puts or hedge aggressive. I think the covered calls for now is a proper hedge. If we lose 3,250, okay, I'm interested now in a hedge using puts on my gold holdings. Anything to see here in copper? If the market views the escalation in the trade war and the tariffs now in Canada, perhaps coming in the EU tomorrow, if the market views it that way, then what we're probably going to see is the market saying, hey, the tariff are probably going to cause lower consumption, aka recession. And you could see a pullback in copper futures. It is a little elevated here above the daily Bollinger Bands. We might see end of the week profit booking from the longs, speculation, a little bit of a pullback. So I would say that the long-term outlook for copper is still bullish, but we might see a pullback, and that pullback you want to use as an opportunity to enter copper. And for those of you who are already in copper, you probably want to use it as an opportunity to add to your shares. How about crude oil? Crude oil is still maintaining the cup and handle pattern. Bad day today kind of reduces the chances for a bull flag breakout here, but it's not definitive yet. It's going to be definitive once we lose the 200 days moving average. So right now, I'm going to give crude oil the benefit of the doubt that it might have went down based on the algos reacting to the inventory news. But unless it loses the 200 days moving average, give it the benefit of the doubt that it could make a breakout and reach 70 again. The Big Kahuna Apple, what do we see here? Is it a bull flag pattern? That's the assumption. Until what? Until we lose 210. Now, we're not going to go short Apple until we lose 207.5. And by lose, I mean closing below. Absent of that, right now, if you're bullish Apple, if you have the 210 calls, 215, you stick with them. If you lose 210, warning sign that the calls may be not going to work, especially if you have July or August expiration date. You lose 207.5, that's your point to begin to enter puts and short Apple. NVIDIA 2 hours chart. We can speculate on the technical patterns all we want, but it doesn't matter really. What matters is what will the options market do. My 2 cents, based on the data that we looked at, is we pull back and we lose 160, and then maybe close a touch above by the end of the session. The souffle Tesla doing pretty good today, moving close to that 313 number. So what is the deal now? Of course, they're touting the expansion of the robo-taxis to San Francisco and Arizona. I say get Austin right before you begin to expand to San Francisco and Arizona. But again, they're using the news to pump. I would say we have to be careful with these pumps because they could fade away quickly. And right now, Two important barometers you have to look at. One is the 200 days moving average that you see right here in orange. It could be that Tesla wants to retest that 200 days by 315.86 and then get rejected again as it did right here. So you see breakage of the 200, retest, failure. Maybe another retest and a confirmation of the failure. Another important indicator is the 50 weeks moving average, right now sitting at 303.39. A close below that number would suggest that Tesla's probably heading to the lows here at the low 200s. So two things you need to look at. Three, really. On the daily chart, you need to look at the 200 days moving average. On the weekly chart, you need to look at the 50 weeks moving average. On the intraday chart, the hourly 2 hours, you want to look at 313. Closing above, bullish. Closing below, bearish. How about BTC breaking out today above 110? So what do we do here? IBIT calls is the proper way to play it. You have the inverse in the shoulder playing out. Is it too excessive, Mav? Not really, because it is an anti-dollar kind of trade, and the weekly chart suggests that we could have more gains to come. And this one has no ceiling. It's breaking all-time highs, so it could expand even more. 120 perhaps could be in the table, so I think the most proper way to play it right now is IBIT calls. Cheap, and it gives you the exposure to BTC. On to the conclusion of this video. What do we have in tomorrow's session, Friday the 11th? We don't have much. We have the federal budget. We have a deficit, so there's nothing new here. I think the most important thing to look forward to is, besides the options expiration dynamics, we need to watch out what's going to happen with the trade front. So right now we have news that Trump is going to tariff Canadian imports 35%, and then probably he's going to announce the EU tariffs. That's the big one. That's the biggie, because the EU is the largest trading partner for the US. So if he goes 40% in the EU, 1,000,000%, the market is going to respond negatively. So keep that in mind. Now, the last announcement I got for you, unfortunately I'm beat up today, so I cannot put out the In Focus, the trade war with Japan video. I know it's the most hyped up video for the week. But we'll finish it, I promise you. It just needs a little bit of editing. So we'll do that tomorrow instead. Until then, folks, thank you for joining us tonight. This is all I got for you, though. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
I hate to break it to you, but there is no big lie. There is no system. The universe is indifferent.
Man, why'd you have to say that?